in Guangzhou, for example, Apple came to quickly realize that its supply chain was incredibly concentrated for the high-end Pro models of its iPhone handset. What has happened subsequently is Apple looking to diversify its supply chain away to nations like India and Vietnam, but for the time being, China's still important. So that was a big topic of conversation. The word stability doing a lot of work in that statement from China. But Tim Cook also visiting an Apple store and meeting with customers there in mainland China as well over the weekend.
Ed Ludlow, thank you so much. U.S.-listed China tech on the move this morning. Alibaba fluctuating between gains and losses. On the news that billionaire co-founder Jack Ma has returned to China. Joining us now is Bloomberg's Isabel Lee. Isabel.
Hi, Lisa. Yes, Ma's move or resurfacing is definitely having an effect. The billionaire first disappeared from public view in 2020 after publicly criticizing Chinese regulators. But on Monday, news surfaced that Jack Ma appeared back in China, visiting a school he founded and talking to staff there about topics including like ChatGPT and others. And analysts say that Ma's reappearance will be positive for the sentiment because they say this will be a regulatory normalization. So you're right, Alibaba is fluctuating between gains and losses. We have the broader index also shedding weight. The Nasdaq Golden Dragon Index is slightly higher. We have the Hang Seng also up and MSCI China also up. So how did we get here? Jack Ma's resurfacing comes as China tries to pitch itself as a hospitable place for business, and that's after a sweeping crackdown on the tech sector, Ma's companies included. The billionaire has been traveling across the world from Vienna to Tokyo to Hong Kong, and that's when Chinese authorities persuaded him to come back and to try to make their case. But Bloomberg reports that Ma is retreated from his companies to focus on agri-tech research. So it remains to be seen. And we have Ma even telling his executives in Alibaba and Ant not to obsess too much over his return. So definitely lots of things unfolding here, but we'll look out for Chinese tech stocks.
Isabel, thank you so much. Let's take a look at some of the other price action this morning, including, and I just mentioned that the Nasdaq 100 has risen 20% from its low in December 2022. Let's head over to Bloomberg's Kaylee Lyons to take a look at what's moving today. Kaylee.
Well, Lisa, it's so interesting that headline crosses, and yet within the sector composition of the S&P 500, it is actually technology and tech-heavy sectors that are underperforming today. Granted, it is a broad-based rally. Pretty much everything is in the green, but communication services only up about 0.1%, and information technology up only by about 0.4. So that is actually underperforming the broader market, which is up about 0.8%. Toward the top of the pile, though, actually at the very top, you have the financials. The financial sector as a whole up 1.8%, and it is those regional banks outperforming. The regionals index up more than 4%, and a large part of that is thanks to the moves we are seeing in the likes of First Republic, up about 19% on more hopes of support from the U.S. government, allowing it more time to figure out its balance sheet. And then First Citizens up a whopping 43% after it agreed with the FDIC to buy $72 billion of SVB's assets at a discounted rate of $16.5 billion. Pretty good deal, and the market seems to like it today, Lisa.
Kaylee, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. As Kaylee was talking about, we are seeing a rally. And on the flip side, you are seeing yields creep just a touch higher now, looking for a 4% Fed funds rate in January of 2024. So still pricing in those rate cuts and that NASDAQ 100, even though it is underperforming the S&P today, up about 20% since its low in December. This is Bloomberg.
like Bloomberg.
This is Bloomberg The Open. I'm Lisa Abramowitz in for Jonathan Farrow. Taking a look at the markets, you are seeing that outperformance continue in the S&P up to 0.6% versus the 0.3% gain that you're seeing in the NASDAQ. If you take a look at what's moving, it really is what we're seeing in the banking stocks. We are seeing yields higher, markedly higher. Two-year yields 3.95%. But if you take a look at the bank stocks, that's where the action is. First Citizens shares are absolutely roaring. 43% gain. First Republic, PacWest, Western Alliance, all surging on the heels of a bit of stability. Time now for the trading diary you need to be watching this week. Fed Governor Philip Jefferson speaking at an event from Virginia at 5 Eastern. 2 days of bank hearings on Capitol Hill kicking off on Tuesday. More Fed speak coming from Barkin and Collins on Wednesday, followed by Williams, Waller, and Cook on Thursday. And finally, rounding out the week with U.S. GDP and another round of jobless claims. What data is going to matter? Last week, we were talking about how the data doesn't matter anymore. This week, will that PCE, that core metric on inflation, really start to matter a whole bunch more? This was Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It
is 30 minutes into the U.S. trading day, Monday, March 27th. Here are the top market stories that we're following for you at this hour. It's a done deal. First Citizens buys Silicon Valley Bank, and it helps stabilize the regionals, with First Republic shares popping 17%. So markets, we back to normal. You got front-end yields jumping higher. Equities, though, also claw higher. We try to figure out the big risk this week. Is it banks or central banks? And not backing down, ECB's Isabel Schnabel, wanted to signal possible future rate hikes in March's statement despite bank risk. We're going to get another view on financial stability from the Polish finance minister. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome everyone to Bloomberg Markets. So Guy, you and I got a weekend. If you're a regional bank analyst, you probably didn't, but we got a weekend. Yep. But my question now really is, how do we think about the next phase of this? Like, the risks are still there, right? Contained, but there. Now what do you do? Now what do you invest in?
Well, look at how the market is reacting this Monday morning. You are seeing bonds being bashed and banks being bid. It's the complete reverse of what we saw last week. But as the underlying narrative changed, Alex, I think that goes to the core of our question. And I wonder whether it really does. Because yes, we've got some important data this week in the form of PCE. Yes, we've got an awful lot of Fed speak. But I still wonder whether it's the banks rather than the central banks that are taking center stage. And here's my reasoning. The thing that we all don't know at this stage is how much the banks are going to tighten up in terms of their lending standards and what impact ultimately that is going to have on the economy. We don't know that, and I'm not sure the Fed does either.
No, we did hear from Neil Kashkari over the weekend that he's getting a little bit more concerned about it. Like, it will impact it. We just don't know by how much. Also, there's a shadow banking conversation. So how much money out there is in debt that banks have lended to that is not regulated by anybody in terms of, say, the FDIC or the Fed, et cetera. And that's a risk as well. But I've been hearing about that risk for a while. It just hasn't yet necessarily materialized.
Yeah, it's one of those things that it's kind of wait, hurry up.
Yeah.
It'll be an issue when it's an issue, and then it'll be a big issue. So let's talk about our question of the day. What is the biggest risk this week? What is the biggest risk going forward for investors? We're coming to the end of the quarter. Central banks or regional banks? Where should you be focusing your attention? To try and answer this question, we're joined by Bloomberg's Mike McKee and Edward Harrison. Mike, I'm going to start with you. I feel like I haven't seen you for a little while, so let's bring you back into the conversation. Where are we in terms of understanding where the risk lies? Is it with central banks reverting to their concerns around inflation and talking up the possibility of further rate hikes from here? You heard what Isabel Schnabel had to say. Or is it in the impact that this regional banking crisis is going to have, which I'm not sure yet we fully understand?
Well, that's the problem. We don't fully understand what's going to happen with the banks. There's an anticipation that we're going to see lending standards get tighter, and that will mean fewer loans being made and slows the economy. But we'd already seen a lot of the banks raise their lending standards. So is there going to be much more movement? And part of the problem there is we don't know what we don't know about who else might be in trouble or what might trigger that trouble. It does look like things are settling down today. If that continues, then you turn your focus back to the central banks. And the question that occupied us for so long of will they do too much tightening, particularly the Fed, will they go too far and send us into recession? It's very hard to know in both cases, but right now I'd probably lean just a little bit more towards the Fed and the ECB than towards the regional banks, even though I would admit I really don't know what's on all their balance sheets.
We kind of figured that, which is why we got Edward too, who will, I think may say something different. All right, so where's the biggest risk then? Is it going to be central banks or regional banks this week, Edward?
You know, I'm not going to say anything different. I'm going to say what Mike's saying there, because you know, I was looking at a quote from Vincent Reinhardt. He's the chief economist at Dreyfus Mellon from a month or two ago. He said Powell wants to write his own page in the history books as someone who, unlike Burns, that's Arthur Burns, a former Fed chair, did not blink and reverse too soon, and unlike Volcker, did not intentionally cause a recession. And I think this is where we are. We're at this this precipice between Burns and Volcker. Who does Powell want to be? And up until this point, we were thinking that he could get away with going between the two, but with the crisis with the regional banks, now we're seeing in a very SNL kind of way what the damage is potentially to the balance sheets of banks, and I think that it's looking more like Volcker, which is great for inflation, but it's also very bad for the banks.
Edward, just sort of taking a step back and thinking about the U.S. economy, my sort of other contention is that maybe we're overemphasizing the impact that the regional banks are going to have in the US economy and how big their potential is to blow the Fed off course in terms of fighting inflation. Compared with what happens here in Europe, and I was listening to Torsten Schlock of Apollo talking about this a little bit earlier, Europe relies on its banking system. It relies heavily on its banking system. The US economy doesn't in the same way. It has a much more diversified funding structure, a much more capital markets funding structure, and therefore has the ability to move between one source and another source and another source of credit. Is there a danger that the Fed overemphasizes the risk to the wider economy that is coming from this regional banking crisis?
You know, I think I would go in the opposite direction. I would say that what we have is a systemic crisis that has a long tail, and I think that the S&L crisis is a good way to think of it. Even though we have a much more markets-based economy and there's less on the balance sheets of banks, the problem basically is that these banks have assets that are yielding less than they did before, and anyone who has assets that are long-term in nature is going to have assets that are yielding less, and then they're going to have to pay more in deposits. So you have a fundamental mismatch because of the rapid increase in interest rates that are going to be kept high. So even though the Fed can get away with a lack of a crisis, an acute crisis, we still have sort of a long tail systemic crisis because there's going to be a bleed for these banks over the longer term.
Which also leads me to the whole shadow banking situation as well, and all the leverage in the system, Mike. How does the Fed look at something like that? Like the banks they can handle, right? In theory, or at least they can backstop it.
Well, shadow banking system is always a concern because you don't know, again, to say what I said earlier, you don't know what you don't know. The general feeling is that there probably needs to be more regulation, but nobody's figured out how to do it yet. So everybody has to keep an eye on what's going on in the private sector. I would disagree with Edward, though, on the long tail of a systemic risk. I don't see this as being like the savings and loan crisis, and certainly not the great financial crisis, because in those cases, it was the loans that the banks had in both